Alrighty, so I wanted to thank you all for joining us tonight for a session with Dr. Zawadi Marshall regarding financial wellness, but also to share a new opportunity that they have for medical students and residents. This will be
I don't
the
even
second
know my
time that
name.
Dr. Marshall is coming to speak with us, and so I'll turn it over to you. Uh,
Thank you.
I'll, I'll just also add that there will be time also at the end without recording. So if anyone has questions that they want to ask without recording, to be able to ask those questions as well.
Perfect. Well, it's a pleasure to be here as always, Dr. Walker. As a physician of color myself, I'm happy to be here to provide resources concerning financial literacy to this association. It was a pleasure being here the last time, and know that Doc2Doc and me personally will stand by each of you as you need to contemplate ways in which you can become more financially savvy. And if you have a need to access capital or to borrow money for whatever personal reason, know that we're here to kind of hold your hand through the process and treat you fairly and transparently around what borrowing actually means. Let me share screen here for a moment, and I'll walk you through a couple of big picture ways in which you're probably wasting money right now as a resident, because we've all been there. I know what it's like myself. And I'll just kind of get to the hot highlights of the top 6 things. And at the end, I will share links to our scholars program that Dr. Walker mentioned just now, where we are providing scholarship grants to a number of you guys, of residents, fellows, and medical students who will get mentorship from members of our scientific advisory committee, in addition to a cash prize. Now, once again, I will disclose that I only have 2 licenses, one to drive and one to practice medicine. So this presentation is meant to be informational only and not to be taken as financial advice. All right. So I was in your shoes, I'd say maybe a decade ago, when I was 26 years old, coming out of Emory Medical School and moving on to Harvard residency at that time. I was completely unprepared for what the financial toll of moving to residency, of moving from residency to my first job, of needing to cover the expenses of having a young family. I had a son born when I was in my residency program, and it all just kind of piled up pretty quickly for me. As I began to try to borrow money from the traditional credit markets, it was clear pretty quickly on that my poor credit score, which was not because of any bad behavior, but because I had a lot of student loan debt and my debt to income ratio was pretty low. The fact that I had very little earnings in residency, if you calculate what we make on a monthly basis and divide it by the 80-hour work week, and many of us work 80 hours or close to it, yes, it's earning less than 14 bucks an hour. And I was completely unprepared for like the financial journey and what a FICO profile means, what debt to income ratios meant as well. And so with that ignorance, I decided to do something about it by co-founding this company with another anesthesiologist who's also a physician and currently in the practice of medicine, where we're now providing financial literacy resources to doctors across the country. Today's talk is going to be, let's say, 15 minutes of 6 ways to build wealth and 6 ways that you're likely wasting money right now. And it'll be a live Q&A afterwards that will not be recorded, so you can feel free to ask questions honestly, and I will do my best to address them as thoughtfully as I can. Now, here's the problem. I think you're all aware of this. As a physician, you likely are burdened by relatively high debt. The average student loan debt currently is north of $190,000 a year. You've got relatively low income at a certain point in your career. Sure, you're going to blossom from being an ugly financial duckling into a beautiful swan when you're done with residency. But while you're in residency, that relatively low income is going to be harming your overall credit profile. There's a delay in the improvement of your credit scores. What does that mean? If I asked 10 medical students what they think the average FICO score is, or credit score for the average American, they'll likely guess it's in the low to mid 600s, and that's not true. It's certainly north of 700, but doctors tend to come out of training with lower credit scores that hurts us at the early part of our career. And then because our schedules are so busy, it's hard for us to find the time to actually do price shopping, to read all the fine print on those loan applications, to understand what an APR is, what a prepayment penalty is, what an origination fee is. It's all very time consuming. And so because we're trying to get it done quickly, we may get into a bad situation without knowing it. Now, why do doctors need to borrow money? Biggest reasons are they're looking for moving expenses as you're going from residency to fellowship. You need to pay rental deposits or down payments in a home. You may be traveling for fellowship interviews or for the application or for research bits. And then there's just a general career development bit. So taking prep courses for board exams or using it for childcare expenses and oocyte cryopreservation, meaning you're storing eggs for fertility purposes. All of these are very common reasons, but the most common reason today in this current interest rate environment is credit card debt and refinancing that debt. If you look at the fine print on your credit card statement, you'll likely see that you're paying over 25% in interest per year on those credit card bills. And getting out of that debt is a very important first step into repairing your overall credit profile. Now, what are these fundamental things that you're not doing right now that you should be doing? Number one, you're not increasing your credit score, meaning you're not being thoughtful around what impacts your credit score and how to make it get better. The biggest thing that I think you can do to be most helpful is regularly check and fix your credit history. So ensuring that you've got a subscription with one of the free credit programs, or even if it's a paid one, look at myfico.com, freecreditscore.com, Credit Karma. It doesn't matter which one you use, but you want to have a cadence of checking your credit regularly. If you use one of these programs, they'll give you a monthly score. You can do a quarterly check, but be keen to look for any mistakes out there because it's not uncommon for fraudsters to hack your credit profile and rack up debt in your name and you don't know about it until you're applying for that mortgage when you graduate from residency and you see that there's an outstanding debt in collections because someone else used your credit report. You want to ensure that you keep the earliest and older accounts that you have, the accounts you had since you were in college, keep them open. You don't close it. You can pay it off and pay it down, but don't close the account. The longer you've got an active credit statement open with a low balance, it's helpful to your credit history. Low utilization matters. So if you've got access to $10,000 in credit limits from, let's call it a credit card for easy examples, and if you've got an $8,000 balance and a $10,000 limit card, you're at 80% utilization. You want to get that balance down to less than 30% to increase your overall credit score. So paying down that 8,000 to closer to 3,000 or less is much better for your credit score. And then finally, paying on time. So use tricks and tips like automating your payments, doing the auto pay program where you can ensure that you're always making at least a minimum payment on time. That will help to show on-time payments, and those consecutive on-time payments all add up to be very helpful for your overall credit score. You're not budgeting is the second most common thing, and budgeting is hard when you only make so much money, and it comes in and it goes out, right? So this is more of getting into the practice of knowing exactly how much money you make after taxes every month, and it's just as taxes, insurance, and all the deductions that come out of your paycheck from your hospital before you get the money in your account, and then carefully review what your standing expenses are, your subscriptions, your cell phone bills, your car notes, and all the things that go into your monthly overhead. And then that'll leave you with some a bit of money, hopefully, that's left over after you pay your overhead. And that's the bit of money that you have to be really, really careful about being responsible in how you save, how you pay down debt, and how you actually live life and have some bit of quality of satisfaction while you're actually in an active residency program. Part of how you know what to do with the money you have left over will be setting up a priority system, knowing how to prioritize what's important. I know that we all love acronyms in medicine, and so you think of this as the dire priorities, which is debt reduction, insurance, retirement, and emergency. Think of debt reduction as what I said in the first slide. That's improving your score and lowering your interest cost. So paying down any high interest debt. All debt is not bad debt, but certainly if you're having revolving debt on credit cards or higher interest debt, you want to get rid of that as quickly as possible. Thinking your about preserving your earning potential. So that's insurance, disability insurance, malpractice insurance, and life insurance. While in residency, you may think that you're young and invincible, but know that things happen to many of us very often. And having the right kind of disability policy can be extraordinarily helpful in ensuring that should you get injured, you have a way to continue to earn while you're still healing from that injury. We will be hosting at Doc2Doc Lending a workshop on disability insurance with one of our partners that has access to and one of the top five big disability insurance companies. And we'll be happy to kind of explain more about how that works. Retirement. This is about getting into a discipline of saving something for your retirement at a very early age. Those who start to save for retirement at the age of 25 will have twice as much money in their retirement account than someone who starts 10 years later. Aim for putting aside 15% of your after-tax income for your retirement savings. And then emergency. Know that it's usually a good buffer to have 3 months worth of salary for the unexpected things that can happen in life. And we can help you think through what a budget could look like for emergency savings with our budget planner. You'll see a QR code at the end of the talk where you can click in and kind of get these tools and resources from us. You're not automating, number 4 out of 6. Make sure you automate the things that you know you have to pay every single month. One of the worst ways to get buried in debt is to have late fees accumulate over time because you just have been paying late. So do the auto pay. Often, if you did auto pay, you'll also get a reduction in your interest rate because there's auto payment savings. So I want you to think carefully about that and do it as often as you can. You also want to ensure that you are saving on auto pay. So what's wise to do is have your employer allocate 15% of your net income that goes straight to your savings account so it never actually hits your checking account so you don't see that money. Think of it as paying yourself first. So that helps you to think about retirement. It helps you to think about having that emergency fund by putting away money at the very top of your paycheck so that it's always going to be there. And then auto schedule the quarterly check on your credit score and also on your paycheck profile to ensure you're always getting the same amount of money every month. Now, there are a ton of free resources that we're oftentimes not using and taking advantage of. One of the biggest places to get free resources is through your HR benefits platform. Oftentimes, your residency program, your GME department will have discounts at phone service providers. They'll have moving company discounts and other things that all hospital employees are entitled to. Take a browse and just check out what the benefits platform has and ensure that you're using the ones that are applicable to you. Also, there's a credit card game that some folks can play, and I want you to be very careful about it. But oftentimes, some cards will offer 0% interest for some period of time. Let's call it 6 months. That can be a way for you to kind of move higher interest debt onto a 0% debt card for a specific period of time, but ensuring that once that introductory period ends, you begin to aggressively pay down the debt. Always, always, always leverage your resources and mentors. Know that the folks like me who've been there where you are now can be helpful in giving you the real advice on what's practical and what's been proven to be effective over time. And then there are these AI tools that'll help you look at budgeting. Wally, Honeydew, and MintZip will kind of log into your bank account and help you to figure out when you're double paying for things, when you have subscriptions that you're not aware of. You're still paying for the HBO Max that you had in college 3 years ago, and you forgot that it's 69 bucks a month every month. So that'll help with those kinds of expenses. Now, This may seem counterintuitive, but it's important. You're probably not borrowing like you need to get into a better financial position. Using debt to pay down higher interest debt is a great way to improve your initial financial position. So, consolidating higher interest loans, I don't feel the same way about student loans. I want to be clear here that student loans should be thought of very differently. It is important for you to refinance student loans that are at high interest, but refinancing student loans may have other unforeseen consequences. For instance, you may lose the ability to have a student loan forgiveness program write off your loans because of where you work. Being in an underserved community, being in a nonprofit hospital, those are things that can be helpful in getting your loans forgiven eventually. If you refinance a public loan into a private loan, you may also lose the ability to have forbearance, which is a period of time of not making any payments at all. So student loans should be thought of differently, and you should have a student loan counselor really walk through the options for you depending upon your unique financial circumstance and where you're going to be working after you're done with residency. But for all other loans, think about getting rid of revolving debt. That's credit card debt that kind of accumulates over time and it keeps revolving month over month as you make payments. It's just there revolving. You want to get rid of that kind of debt and replace it with what's called installment debt. That's a fixed loan to pay off the credit card. Every payment you make on an installment loan goes towards reducing the principal balance so that you're out of debt after a specific period of time. So consolidate whenever you can from higher interest loans into lower interest loans. Now, a part of who we are as Doc2Doc in funding the company, I mentioned that my co-founder, Dr. Kenton Allen, has also lived through the hardship of being in medical school and residency and having a family while in residency. We both trained at Harvard. I went to Emory for med school, Kenton at Dartmouth for medical school. We're both MD MBAs, and so we have a keen interest in finance and how money works and how money and credit performance impacts doctors and our risk of burnout and our job satisfaction as well. And that's part of why we're here. I shared earlier that we've got a new scholars program. I think this is what you're all waiting for. This QR code will allow you to register for the opportunity to win a $1,500 cash prize. You'll have three 30-minute mentorship sessions with members of our scientific advisory team. The application period is open right now. It closed on October 15th, so you've got just under a month left, and we'll announce our winner at the end of October. So I hope that we have several winners coming out of this cohort at this American Association of Black Family Medicine Doctors. Now, here's my QR code for you to contact me. Here's a QR code for you to visit Doc2Doc where we have those resources and tools and budgeting for you. I will leave this screen up for the moment. And should you have any questions for me, please do let me know. I will remind you, though, that Dr. Walker shared the earlier slide, the QR code for this organization. You should use that code and that link because it helps to ensure that we track it and give you guys credit for being a part of our program as well. So let's stop the recording, Dr. Walker, and we'll begin to take questions.
If anyone is okay with asking questions on the recording, that'd be great for others that weren't able to attend, but we'll leave some time also without recording. Thank you so much for sharing that information and
You're welcome.
the program. I'm excited for people to apply.
You're very welcome.
Does anyone have any questions they'd like to ask?
Yeah, sure. I'll ask a question. So I'm a med student about to graduate and preparing for residency. What are some tips going into, residency program and even applying, having all these extra fees to apply and interview, to start budgeting now. I find myself, like you said, credit card debt. I try to pay them card off, but it sometimes gets a little heavy with extra unexpected fees. But outside of credit card debt, how do you start building on investments or saving?
Yeah. So when you're in medical school, it's really hard. It's almost impossible. So I don't want you to get too impatient. and think that there's more you should be doing now when, medical education costs north of 50,000 bucks a year. There's all kinds of debt that you have. So be patient with yourself while you're at this phase in your career. Ensure you speak to your financial aid advisor though, and ensure that you have tapped out all of the cheap money available through subsidized loans that the school may be able to give you. And some of those expenses that you have may be covered by your loan, by your subsidized loans. So don't presume that you couldn't use some of that money for these expenses. A lot of it you can't, but if there's any bits that you can, make sure you maximize those as well. The last thing is, I think credit card debt, borrowing from your parents and family members, if you've got any bit of savings from a fund that your parents put together for you before, now is the time to use those resources while you're applying for residency and getting in. Once you're into residency, you begin to make some money, though it's not much. Having a disciplined budget can help you to pay down those loans, but you also have access to resources like ours at Doc2Doc, where we will fund up to 15,000 bucks for people that need to relocate from med school to residency once you've matched at match day in March in 2025.
There's a question in the chat. Is it better to buy a car while in medical school to use subsidized loans or wait for residency?
I think it depends upon what kind of loans you have and what the rates of the loans are. If you've got subs today, loans are still pretty high, even subsidized ones, and the rates can be north of 6 or 7%. And a car loan itself, without using subsidized loans, can be similarly priced or a little bit cheaper. So do the comparison. It all depends upon what the rate is and what the terms are and how urgent the need is, right? Like, don't put off buying a car for residency if you have no way of getting to your rotations right now. You need that car today. So these are all expenses that are essential to you being successful, and know that you will make the money in the future. Like, we all survived it. You will too. But these are tips and tricks to kind of come through that process and still maintain your sanity.
I wanted to piggyback that the loans that you all do provide, would it be able to assist with purchasing a car?
You can use our loans for any personal reason, but I will not recommend using it for a car purchase because that's a different kind of loan. A car loan would have a better interest rate than a personal loan would, because should you not pay that car loan in time, they will confiscate the car. So they have collateral. Whenever a lender has collateral for a loan, they can offer a cheaper rate because they've got a guarantee that protects their money. A personal loan like the one that we give, there's no collateral. We're just banking on the fact that you're a doctor, and we hope that you're going to pay us back. But should you not pay us, we've got nothing to collect or take from you. So the rates for personal loans are always going to be higher because of the risk compared to a car loan. So no one should use our loan to buy a car. But once we give you the money, you can use it for whatever you think is best. And you may decide that based upon your circumstances, you can't get a car loan for whatever reason, you can use our personal loan to do that. Or maybe a used car that from a family member. We just need to get 5 or 6K to buy it from a friend or family member. Then that's where we would come in that instance.
I'd also add that if people are looking into car loans specifically, especially if you're making that transition, to consider credit unions, even if you don't currently have a credit union. They usually have cheaper rates. And then you can also tell them that you're going to be a resident. And they sometimes have like essential worker discounts as well.
Great advice. Very good advice. You're welcome, Jalissa.
If there are other questions, you can unmute yourself or raise your hand.
Okay, I have another question. So buying a home, there is the physician loan. What are your thoughts on that physician loan with buying a home, your first home?
So I did it. I like it a lot. A lot of lenders have the program. Truist Bank does, Regions Bank does. Some of the credit unions will have a physician loan. And the big things there are this: less money down. So oftentimes it's 0% down payment for loans that are less than 500,000 bucks, somewhere between 5 and 10% down payment for ones that are less than $1 million. And with no money down, you don't have to pay mortgage insurance, which can be quite expensive. If the average American were to put less than 20% down in their loan, they have to pay for an insurance policy to insure that mortgage, and that can be a couple hundred to a couple $1,000s per month. So knowing that, that's a great program that exists across the US, and I think it's highly recommended. But do a comparison of what's being offered by the physician mortgage that your friendly banker offers you compared to what someplace like Rocket Mortgage would offer you.
Any
If
other
more
questions?
questions come up, and you can't think of them now, please feel free to reach out to us. You've got my contact card. Ryan also has my direct line, and we'll be happy to be a resource to you.
I'll stop the recording now, and then if people have additional questions, they can ask those questions as well.